What if you could earn more than $16,000 in 2026 and pay absolutely no federal tax on it? For many Canadian seniors, this is a reality. The government has updated the basic personal amount of BPA to a projected $16,452 for 2026, creating a significant legal tax-free opportunity. The problem is, many retirees will not take full advantage of this. Taxes are one of the single biggest expenses in retirement, and unfortunately, many Canadian retirees pay thousands more than they have to. I'm Toyin, a CPA and financial planner here in Canada. I'm glad you're here. In this video, I will show you how this tax credit works and how you, as a senior, can combine it with other credits to earn even more, completely free of federal tax. Today, I'll walk you through 4 specific strategies that will put you in control of your retirement taxes. Before I explain the math, understand this. This isn't just a deduction. It is effectively 100% tax holiday on the first $16,000 you touch. Here's exactly how it works. The first piece of the puzzle is the basic personal amount, or BPA. This is the amount of money every Canadian can earn before the government starts taking any federal income tax. For 2026, that amount is projected to be $16,452 for anyone with a net income up to $181,440. This means if your taxable income is $16,452 or less, your federal income tax bill will be zero. Now, it's important to understand how this actually saves you money. The BPA is a non-refundable tax credit. This means it's not a cash payment to you. Instead, it directly reduces the tax you owe. The value of this credit is calculated at the lowest federal tax rate, which for 2026 is projected to be 14%. So for 2026, the tax saving from the BPA is $16,452 multiplied by 14%, which equals a direct reduction of $2,303 on your federal tax bill. Every taxpayer gets this, but it's especially powerful for retirees who often have more control over their income streams. This increase isn't a random number. It's indexed to inflation to help your money maintain its purchasing power. Federal tax brackets and credits are adjusted based on Consumer Price Index, which for 2026 is based on a 2% inflation factor. The increase from the 2025 BPA of $16,129 to the 2026 amount of $16,452 is a direct result of this indexing. So, strategy number 1 is to recognize the baseline. You have $16,452 that you can earn federally tax-free. This is your foundation. For seniors, this is where it starts to get interesting. Let's move to strategy number 2. If you're 65 or older, the government gives you another powerful non-refundable tax credit, the age amount. This is where you can amplify your savings. For the 2026 tax year, the maximum federal age amount is projected to be $9,208. When you add this to the basic personal amount, you get a powerful combination. Let's do the math. A BPA of $16,452 plus a projected age amount of $9,208 gives you a total of $25,660 in federal tax credits. A qualifying senior could potentially earn up to $25,660 and pay no federal income tax. But there is a critical detail. The age amount is means tested, which means it starts to be reduced as your income gets higher. Based on confirmed CRA figures for the 2024 tax year, that reduction started once income exceeded $44,325. For every dollar earned above that threshold, you lost 15 cents of your age amount. These thresholds will be indexed higher for 2026, But the rule is the same. To get the full benefit, your income needs to stay below that starting threshold. This creates what I call the tax control window, especially for those between ages 65 and 71. In these years, you have significant flexibility. You have not been forced to start IRAF withdrawals yet, and you might have the option to delay CPP or OAS. This gives you the power to structure your income to stay below these clawback thresholds and maximize the credits you're entitled to. And if you're married, if your spouse doesn't need their full age amount, they may be able to transfer the unused portion to you, which can increase your tax-free income potential even more. Theory is one thing, but let's look at a real-world example. Let's imagine a retiree. We'll call him David. He's 68, single, and planning his retirement income. For 2026, David plans for an income of $50,000 sourced from his Canada pension plan, old age security, and RSP withdrawals. Without strategic planning, here's how his federal tax would look. His taxable income is $50,000. This falls into the first federal tax bracket, which in 2026 for his income up to $58,523. So his income is taxed at 14%. The initial tax calculation would be $50,000 multiplied by 14%, which is $7,000 in federal tax. But David is over 65, so he can use both credits. Let's see how that changes his tax bill. First, he has the basic personal amount of $16,452. Second, because his $50,000 income is above the clawback threshold for the age amount, his credit will be reduced. Using the 2024 income threshold of $44,325 as our guide, and remembering this number will be higher in 2026, his income is $5,675 over the line. The clawback is 15% of that amount, which is $851.25. This is subtracted from the full protected age amount. So his 2026 age amount would be an estimated $9,208 minus $851.25, leaving him with an $8,356 credit. Now we add these two credits. $16,452 BPA plus $8,356 reduced age amount equals $24,808.75 in non-refundable credits. Here's the critical step. These credits are not subtracted from his income. Their value is calculated at the 14% tax rate and then subtracted from the tax he owes. So we take the total credit amount of $24,808 and multiply it by 14%. This gives us a total tax reduction of $3,473.23. Finally, we take his initial tax bill of $7,000 and subtract his credit. $7,000 minus $3,473 equals a final federal tax bill of $3,526.77. By applying just these two credits, David reduced his federal tax bill from $7,000 to just over $3,500. This is a saving of nearly $3,500 in 1 year. Imagine that saving repeated over a 20 to 30-year retirement. That is tens of thousands of dollars kept in your pocket. David is saving $3,500 using this strategy. Let me know in the comments, are you currently using the age amount credit or is this new to you? This brings us to strategy 4. Control your net income to maximize these benefits. As we saw with David, the tax you pay and the credits you get are tied to your net income. The lower you can keep that number, the more benefits you can claim. One of the biggest pain points for retirees is the old age security clawback. For 2026, this clawback is projected to begin when your net income exceeds $95,323. For every dollar you earn over this, you must repay 15 cents of your OAS pension. This is on top of losing your age amount. So, how do you keep your income down? The number one tool you have is a tax-free savings account, TFSA. Any money you withdraw from a TFSA is completely tax-free, and critically, it does not count as income. This means you can pull thousands from your TFSA to supplement your lifestyle without pushing your income into a higher tax bracket or triggering a clawback. This is why the order of operation matters so much in retirement. It often makes sense to draw from taxable accounts like RRSPs and RIFs first, but only up to the point where you maximize your tax credits. For 2025, that means drawing enough to use up your full $16,452 BPA and your age amount, and filling up the rest to the lowest 14% tax bracket, up to $58,523. For any income needs beyond that, you can turn to your TFSA. This is what gives you control. By choosing which accounts to draw from strategically, you can effectively set your income level for tax purposes, making sure you get every credit you're entitled to. Let's recap. First, every Canadian can earn over $16,000 federally, tax-free, in 2026, thanks to the indexed basic personal amount. Second, as a senior, you can add the age amount to this, potentially creating over $25,000 in tax-free income. Third, as we saw in our example, applying these credits correctly can save you thousands of dollars every year. And finally, by using your TFSA strategically, you can manage your net income to protect both your credits and your government benefits. The real goal isn't to eliminate taxes, it is to control it. In retirement, control is freedom. It gives you peace of mind knowing you are not paying a dollar more in tax than you need to. Thank you for watching, and I'll see you in the next video.